Good morning, everyone. There you go. You're good. Good morning, everyone. This is Mackenzie Sykes with the ASRS. Thank you for joining us. As a reminder, this meeting is currently being live streamed to the public and recorded. We are nearing the scheduled start time of the investment committee meeting. Please be patient while we confirm that our virtual participants are online. Thank you.
I have to get back to my speaker. I can barely hear.
We put back on, what you were before. I know, go back, click again.
Me?
And then we can go to class, like, once it's off, I'll adjust it. Starting that.
Mr. McCarthy, the time is 9:30 a.m. We are ready for you to start at your discretion or when you are ready. Once you have called the meeting to order and the official roll call has been taken, I would like to take a moment and review the meeting guidelines. Thank you.
Yeah, good morning. Is Paul in the room? If they can't hear me.
Mr. McCarthy, could you repeat that for us?
Is Paul, present? Hear me. I'm muted.
No, yeah, I'll take care of you.
You can't hear me?
We can hear you now.
Okay. Is Paul present?
Yes, he is.
Okay. I had a conversation with him earlier. Was unable to get my diligent working, and maybe Diane was going to go negotiate chairing the meeting.
Yeah, and that's already
correct,
and that's facilitated. Diane is here, trustee Landis, and she is ready to facilitate at your discretion. Thank you.
Very good. Thank you. I'll turn it over to you, Diane. Thank you.
Thank you, trustee McCarthy.
My apologies.
No problem. Do we need to do a roll call?
Yes, we do. Will the following individuals please confirm you are present at the meeting by stating here as I call your name? Kevin McCarthy,
Here.
Diane Landis,
Here.
and Jay Petkunis.
Here.
Ms. Landis, we do have a quorum present. Now I would like to read the meeting guidelines and reminders. Please remember that this meeting is being recorded and live streamed to the public. All speakers, please remember to identify yourself before speaking. All mics should be muted unless you are speaking to eliminate background noise. All cell phones should be set to silent. Once motions are made, I will take the vote by roll call, and once completed, the committee chair will announce whether the motion passed. This will ensure it is clear to the public how each trustee voted and the minutes are documented accurately. All presenters, please refer to the page numbers of the packet found in the upper right-hand corner of each page in blue as you move through your presentation so that attendees can follow along. If we have any members of the public wishing to speak, you will have the opportunity under the call to the public agenda item 7. At that time, the committee chair will ask any members of the public have requested the opportunity to speak, and I'll read the names of each person who indicated that they do. Thank you.
Okay, next on the item is consent agenda. Do we have a motion to approve the consent agenda?
I move the approval of the consent agenda.
Thank you. Do we have a second?
Second, this is Jay Pitkunis.
Vote.
Hearing a motion by trustee McCarthy and a second by trustee Petkunis, I will take a roll call vote for the motion to approve the consent agenda. Please answer aye or nay when I call your name. Kevin McCarthy,
Aye.
Diane Landis,
Aye.
and Jay Petkunis.
Aye.
Thank you. The vote has been taken.
Thank you. All right, I think we have Rose Dean up next for a presentation.
Great, thank you. So today I'll be presenting to you our second quarter 2024 investment oversight report. I'll start with the page 14, the market environment. We actually discussed the second quarter market performance during our last board meeting, so I'll be brief on this. Just as a quick recap, the first half of the year, we saw another very strong performance for the stock market. Overall, if you just take a look at that 1-year column, you see that stock markets in general, especially US stock markets, have been tremendously strong. If we turn to page 19, since the second quarter, a lot has happened, and we've obviously seen inflation data come in softer, closer to the Fed target. So as you're well aware, the Fed lowered the interest rate by 50 basis points a few weeks ago, which we thought was relatively aggressive given the fact that the economy is still relatively resilient. But this was, in any case, a really good boost to what was already a strong stock market. And year to date, we see large cap stocks up another 20%, credit markets up 6 to 8%. So this strong public markets performance does have an impact in terms of your short-term performance evaluation. We've mentioned this several times before, because private markets that you have in your portfolio, or really any private markets performance, takes longer time in terms of realization and catching up to the shorter term public markets valuations. This may continue for the time being. The market is pricing in another 50% chance of 50 basis points cut before the year is out. The market's been consistently overreading the Fed's inclination to ease rates, but again, there's a lot of things going on, including increasing geopolitical unrest. So there's a lot more uncertainty here, but so far we've seen this public markets respond very positively to the Fed's action. So moving on to the oversight report on page 28. Great. So on this page, we show your investment objectives as specified in the strategic plan and the extent to which those objectives have been met. And the commentary shows the details as to how these goals were achieved or not. And lastly, we show whether there is any action being recommended by the board or the IC. The portfolio has met your objective number 1, which is to maximize return at an acceptable level of risk. The portfolio has also met your objective number 6 with respect to cash management. You note here that as of the end of the second quarter, the other objectives have been partially met. Objective number 2, achieving the returns in the top quartile of the peer universe. The total fund return for the shorter term is below median, but over the longer term, the fund is still in the top decile among the peers, and we'll show the details in a few slides. With respect to objective number 3, exceeding the strategic policy benchmark performance, again, this goal has not been met in the short term, but due to the strength of the public stock market and credit market, as I mentioned, but over the longer time period, the fund has handedly outperformed the policy benchmark. Objective number 4, exceeding the assumed rate of return, same thing. It didn't exceed the assumed rate of return for the 3-year period, but for all other periods, the objective has been met. Objective number 5, beating the respective asset class benchmark performance. Again, in the shorter term, private equity and credit, which are in the private markets, mostly has underperformed the respective public markets benchmark, but over the longer term period, it has exceeded the benchmark performance. So that's a quick summary. All these goals have been met in the longer term, and there's no concerns about the performance of the portfolio. So we're not recommending any action at this time as a result of reviewing the performance. I'll go into a little bit more detail on page 30. So you see the top line, which is the total fund net of fee performance over historical time periods shown in percentage terms. The line below shows your strategic asset class policy benchmark, again, in percentage terms. And then the numbers next to those percentages in parentheses is the rank among your peers in terms of percentile. And your peers, as a reminder, is a public funds over 1 billion. So during the second quarter, the total fund returned 1.18%. And then for the 1-year trailing period, the fund returned 9%, which is an impressive absolute return for any 1-year period. But it did underperform the policy benchmark due to the fact that, again, public markets have been very strong, and your benchmarks comprised largely of public markets. If you look at any period longer than 1-year period, the portfolio, again, as I mentioned, significantly outperformed the benchmark. And if you look at the 10-year period, the total fund returned 7.55%. versus the 6.42% return of the benchmark. And the 20-year period, the portfolio returned 7.5% versus the 6.8% for the benchmark. So the portfolio ranks actually in the top decile for all periods, 3 years and longer. So this is an impressive result. And this actually meets your objective number 2 and number 3 as stated in your strategic plan. And your objective number 4 is to exceed the actuarial assumed rate of return of 7%. And you see that, again, for all periods 1 year and longer, this goal is also met. On page 33, as usual, we'll look at the 5-year risk-adjusted return. As I note each time, this picture is consistent over different time periods. Your 5-year return of 8.49% exceeds the benchmark return of 8.06%. And you rank at the top 10th percentile among peers for that 5-year period. If you look at the median return about halfway down that table, the median peer return was 7.16%. So you've significantly outperformed the median return. And then as a measure of risk, if you look at the standard deviation, the volatility of this particular portfolio over that 5-year period was 7.56%. That puts this fund at the top 3rd percentile in terms of low volatility. So this has been consistent historically. This is really a testament to the prudent portfolio allocation in terms of diversification, and then the implementation by the staff. Again, if you look at the median standard deviation or the volatility of the portfolio return for your peers, among your peers, the median standard deviation is over 10%. So your portfolio has experienced much less volatility in terms of its returns over that period. So we continue to believe that the portfolio is being managed efficiently in terms of converting the risk being taken into return. And the staff is generating returns at a prudent level of risk. I'll turn to page 37 to look at the performance of each asset class versus its respective benchmark, your objective number 5. We've noted that this is partially met. This story is actually very similar to the recent quarters, where if you look at the 3-year period, you see that the excess return is positive for all asset classes. Where you are seeing the difference in the 1-year period is the private equity and largely private credit asset class here, which underperformed the very strong public markets benchmark. For credit, there were some write-downs that impacted the performance, but the public benchmark of leverage loans plus 2.5% was very strong, over 15%. So you'll see that short-term underperformance. Again, this is not a recommendation as to how to measure private markets performance. You'll see in a few slides the longer-term IRR or money-weighted return, which shows that these asset classes are delivering its target returns. Very quickly on page 40. This is your asset allocation compliance. You see your interim targets, your strategic targets, and the range within which you're allowed to have your asset allocation. And you see that the allocation as of end of the second quarter is within the allowable range for all asset classes. I'll turn to page 43 for the IRR, or the money-weighted return versus the time-weighted return that I just discussed. And I'll focus you on the longer-term results for 5 and 10 years. You can see that the private equity performance is in double digits in terms of the money-weighted return. You can see that credit is exceeding 9% return, and the real estate is returning 6.1% over the 10-year period. So this is very much in line with our expectations in terms of the performance of a private equity allocation, credit allocation. Real estate obviously has suffered in the past 5 years, particularly due to the impact of the COVID crisis. Lastly, I'll turn to, page 44. This is the summary of the asset class committee meetings that took place since our last report to the board. It is part of NEPC's fiduciary oversight duties to observe and ensure that the proper processes are being followed to make these decisions. During the second quarter, 6 committee meetings took place, within which 10 manager recommendations across private equity, credit, and real estate were approved. So in summary, your portfolio is being implemented according to your plan objectives and achieving its objectives across the board over the longer time period. We have no recommended action for the IC, and I'll be happy to take any questions that you may have.
Do we have any questions?
I don't have any. Thank you.
I do not.
I might have one, and I'm kind of looking for it here. Sorry, this is smarter than I am. On page 23, talks about a 2024 global election super cycle. What exactly is that?
More than half the world has gone to or will go to election or polls during 2024. So it's just to point out that there are a lot of changes happening in terms of the regimes that may impact the market performance.
Okay, thank you. And I think I had another one. I think it's on page 37. Okay, this is smarter than I am. Oh, I was just commenting on the 16%. Okay, and maybe one more. So on page 38, I see that, let me get to, cash seems to be trending down. Is there anything to infer from that? From like June 23, you know, on down to now, April, May, June, anything? Does that mean anything that we need to care about? Or is it a good thing or a bad thing or a non-thing?
No, this is just aggregating cash balances to ensure that there's from our perspective as your fiduciary oversight, that your cash flow is being managed so that we do not miss any external cash flow needs. So there's no cash flow needs that has not been met.
The fact that it's lower though, does that mean there's less going out? Or is
No,
that maybe a question for somebody else here?
this is not just benefit payments or anything. This is total aggregated cash flow. It could be manager cash,
Gotcha.
manager calls in terms of your committed capital. So this
Okay.
is an aggregate of the external cash.
Okay, perfect. Thank you very much.
And if I can add to that for me,
Mhm.
a couple of things. Number one, you cannot infer from that whether our external cash flows are going up or down,
Okay,
because that's a function of a bunch of things, including the extent to which we're taking cash balances and then putting on futures contracts on top and taking an equity position.
okay,
So it's a combination of fund management, portfolio management, and external cash flows, as well as cash flows between internal portfolios and being prepared for a capital draw, say for private equities and so forth. So with respect to your question, can our external cash flows going up or down? And I think that's the grand question. And the answer is no. We're pretty consistent over the last several years that we have a negative cash flow of approximately $800 million a year. And that has not significantly changed through time.
okay.
Thank
Thank
you.
you. Appreciate that. Perfect. Thank you.
There's some cyclicality to it as well. So you'll see in July 23, you'll see that number is a little bit bigger, 178. That really has to do with folks retiring around that time. So I
Okay.
expect to see, if we had the July 24 number, that would also be over 100 million. So there's a little bit of cyclicality to it as well.
Perfect. Thank you very much. I appreciate it. All right. If no more questions, go on to,
I had, this is Jay Petkunis. I had one other question that I think I'm probably going to save for when we dig into the asset class updates, but I understand the benchmark that we were comparing in. So you go to page 37. I understand the benchmark we were comparing against for the credit asset class and why that some of the challenges there. I'd like a little bit more clarity on the private equity benchmark, but I think I can save that until we get to the asset class discussion. I just wanted to lay that out there that I'll be asking that down the road.
Thank you.
thank you.
Thank you for the warning.
I'd like to give you more notice than that, but thanks.
All right. Ready for Mr. Viteri?
All right, we're agenda item number 4. I'll wait for the investment management team to come on up. So we'll have Cole presenting on public equity, Sammer presenting on private equity. Real estate will be presented today by Mr. Taylor Mammon. Just to remind the investment committee, Taylor's the Chief Executive Officer of RCLCO. RCLCO is staff's real estate consultant. It's really an extension of staff. They involve themselves in all the underwriting and due diligence and all the assets that are purchased by our real estate GPs on behalf of the ASRS. So all those assets have to be underwritten. They have to be certified, initial certification, final certification, approved at the RCLCO committee before they come to us. So it's a pretty rigorous process. But Taylor's been with us a long time, so he's sitting in for Mike Copeland today. After that, we're going to have credit being presented by John Trusiak. John is the interest rate sensitive portfolio manager, but he works very closely hip to hip with Al on the credit portfolio. So John is really a co-portfolio manager there. So John will be presenting on that. So that's the lineup for today. I'll hand it over to Cole to present on public equity. Thank you.
Thank you, Mike. Excuse me. So if we could start on page 58. And real quick, my name is Cole Smith, Senior Public Equity Portfolio Manager here at ASRS. And yes, I will provide the update on the public equity asset class. All right, thank you. So on 58 here, we're looking at performance to start. We have total public equity in the top table, and then we break it down into domestic equity and then international equity in the subsequent tables. So regarding total public equity, I would first like to point out that we have earned returns above the 7% required rate of return over the longer time periods, including the 5-year, 10 years, and since inception, which does help the total plan get closer to being fully funded in the long run. So we're proud of that. And now I'd like to focus on the excess returns. So here I want to highlight the progress we've actually made over the last 5 years since we've actually adjusted our investment strategy for public equities. So as the cover memo stated, public equities have had mixed returns, but that really is primarily because if you look at the 5-year and 10-year excess returns, they still are negative, while the shorter term trailing returns are positive. So over the course of 2018 through 2020, we did remove active management and factor strategies that were consistently dragging down returns. As a reminder, we did fully adopt an enhanced indexing methodology to our equity portfolios. In this case, we take very little active risk, what we call tracking error or deviations away from the benchmark. We try to compound these small but positive excess returns. Since making the change, we've had positive excess returns in every single calendar year. So I just want to make sure that is noted. And you can see the trailing returns are starting to show up in the 1-year and 3-year numbers. The 1 year, we've earned 20 basis points excess, the 3-year, 21 basis points excess. And by this time next year, we believe that 5-year number will be positive, and then we're going to continue to chip away at the 10-year number as well. So we're very happy with the shift we took over the last 5 years and changing the strategy, and the public equity portfolios are certainly benefiting from this. Looking at the next 2 tables here, the one thing I really do want to point out is how U.S. equities have really outperformed international equities just across all time periods. It's phenomenal how exceptional U.S. equities have been over this time period. And for the record, our benchmark is 64% U.S. equities, 36% international. So the composition of our benchmark has benefited us as well because U.S. equities have been outperforming for quite some time. If there's any questions, I'd like to take them. If not, I will move on to page 60.
Any questions? Trustees? No?
None here.
Thank you. If we go to page 60, please. Okay, here I'm just going to present some basic asset class statistics. So starting in the top left, we see that total public equities, about 23.3 billion as of the end of June. We're still the largest asset class in the total plan, making about 42% of total plan. We manage 8 portfolios internally, and that's all of the domestic equities, again, all managed internally. The other 35% of public equities are managed externally by index managers like ourselves. In the top right, we look at our portfolio compared to our benchmark. So we can look across regions and market capitalizations, and we see that there are no tilts to speak of. We are right on line with our benchmark, as the table shows there. And the bottom left, we can see the sector composition of the benchmark and thus our portfolio. It's no surprise that technology is the top sector. It has been for quite a long time, at least a decade, and especially the last 2 years with the AI theme really taking hold. Technology has really taken off and kind of trounced the rest of the sectors there. We had a drawdown midsummer. Nonetheless, tech is still at the top of the list there. If we look to the bottom right table, we can see the top 10 portfolio holdings. As Rose had in her presentation, she mentioned the Mag 6. You may have heard in financial media and the news, hear the term Mag 7, Magnificent 7 quite often. Well, we have the Mag 6 in the portfolio here. Tesla did fall off because they had a rough start to the year. But again, these top 6 names in the portfolio have been there for some time and likely will be so. So if there's no questions on this page, I will move on to the next.
Questions?
No, none here.
Thank you. We can move on to page 62, please. And here I'll look at our public equity house views. So first, let me start by rewinding the clock back to December when we presented our annual implementation plan. So back then, we projected the S&P 500 should end the year somewhere between 4,300 and 5,300, which was very decent returns, but modest. By the time we presented in June, if we all recall, we had already exceeded that target. And here we are today. With the S&P just above 5,700, and again, as Rose mentioned, a gain over 20%, about 22% year to date. What this means, though, up there. I'm sorry, but if you just see the headline number of 5,700, you wouldn't notice the volatile summer we just experienced. Starting in mid-July, a slew of factors contributed to a drawdown in the equity markets of nearly 10%. It started with lackluster earnings from this Magnificent Seven, these tech companies. Furthermore, you had the Bank of Japan raise their key interest rate, which unwinded the Japanese yen carry trade. All this volatility exacerbated through the market at a time when markets are very illiquid. Midsummer, everyone's on vacation, markets tend to be illiquid, so volatility can really spike. And this is what happened. For example, Japanese markets were down 20% in just 3 days when all this occurred. Some of the largest names in our portfolio, NVIDIA as an example, over a 3-week period from mid-July to early August was down 27%. However, as we know now, all that's behind us. Again, you would notice this if you look at the headline number, because we have marched right back to all-time highs, and that's where we rest today. And so now that we're at all-time highs, what this does mean, though, is valuations remain in the top decile. So we measure valuations by looking at price to earnings ratios, both backwards looking and forward looking, and they are in the top decile. What this means is when we're stretched like this, forward returns may be harder to achieve. It gets a little tougher to have great returns going forward when we are stretched. But looking forward to the remainder of the calendar year, again, it's hard to see how we can push much higher from here, given how far we've come already this calendar year. Over the next 3 months, we have a lot to digest. We have elections. We have earnings season starting again next week. We have Fed policy decisions and central bank decisions across the world. All of these can have a big effect on equity markets. Equity markets are resilient. I would remind everyone that, oftentimes we can look past these risk events and it's kind of amazing how they can digest some of this volatility. But there is a lot to be done. If companies can report great earnings next week, and even more importantly, provide stronger forward guidance, then it's not inconceivable we could push 6,000 in the S&P by year end. Some strategists are calling for that. I don't believe we're quite in that camp. 5,700, if we know the year right now, we'd be very pleased. But there's going to be a lot of wood to chop over the next 3 months. By the time we present in December, we'll have a good update and we'll see how far we've come since today. So those are all the remarks I have prepared, and please let me know if you have any questions.
I don't see any questions, so.
Thank you.
Good morning, Mr. Chair and members of the committee. My name is Samer Gadar for reference. I will be presenting starting at page 66 of the deck. Sorry, my voice has been out for a couple of days, but I think it's already loud. So if we look at the returns on the 3-month, 1 year, 3 years, I need to stop here and explain a couple of things. These are time-weighted returns, and the benchmark that we use, this is for Trustee Jay, we use public markets with 3-month lag. And as Cole just presented, public markets have done very well globally and in the US in particular, and the US is the biggest chunk of it. So on the short term, we will underperform naturally. There's another layer to private equity, which private equity have been lagging for a while, given what's happening in the market, especially on the liquidity and exits, for multi reasons that are, I would say, partially related to interest rates environment, which was extremely high for transactional activity. Debt markets were, they technically shrunk massively last year. So there was extremely tight activity, and with low activity, it will affect returns and exits because you need to mark these assets on real terms. But if we look at our portfolio, although we don't use private equity benchmark, we still look at it. And I would say the only benchmark that I would say is reliable would be Cambridge Associates. It's available on their website. And if we look at Cambridge Associates, a benchmark, it was down negative last year and our portfolio was positive. I would say the difference was north of 6%. Positive for us. And now I just looked at it before coming to this meeting. Even this quarter, which is valuations of June, we still outperformed that benchmark. So I was slightly afraid that in a recovery of private equity, we might not catch up. Actually, so we are performing better on a down market and performing better on an up market. If you look at the left-hand side, lower left-hand side graphs, this is our IRRs, which is the capital yes, it's the dollar weighted returns, and TVPI, which is our total valuation. You can see it's stable at 1.6 for the total valuation, 1.57. And on the distributions, you see the gray line, which is called DPI. So we had a technically better than the market in terms of distributions because our capital calls are equal our distributions, which is something the market doesn't have or other managers don't have. I think the distributions would be 50% less than capital calls. So although liquidity is low, but we're happy to say on the second, on the right-hand lower graph, you see our cash flows. So the red bars are our distributions and the orange bars are contributions, mean capital calls. If we take out 2020 and 2021, because they are out of the norm. 2020 was the COVID and 21 was the recovery. You can see in 21, we had $1.65 billion in distributions. However, in 2020, we had around 600 million. This year, our distributions and contributions as of yesterday are equal. And this is way better than what we're seeing in the market. I will stop here. And I'm not sure, Trustee Pakunis, if I answered you, but I'm happy to take more questions on this.
Samer and Trustee Pakunis, if I may. So with respect to the benchmark question, so this happens time and time again. Anytime you have a publicly traded benchmark relative to a private market asset class. We've had private equity for nearly 17 years, 15 years, let's say. And if you go back and you look at the history, you'll see that equity markets rally, our private equity performance lags. When equity markets tank, private equity ends up looking like heroes. And when you go back to even further than that with other public pension plans that have, let's say, 40-year histories in private equity, the pattern repeats. So it's really a function of that we have a publicly traded benchmark comparing your private market assets. Now, why have we done that? One of the main reasons was we're using private equity as an option to public equity. So it's an opportunity cost, right? So we like measuring how our private equity portfolio is doing relative to the opportunity cost of being in public equity. Now, if we could have, let's say at the beginning of this year, snapped our fingers and been out of private equity and been in public markets, we look like heroes, but you can't do that. But it's still good to look at the opportunity costs. There are other benchmarks that we look at, just like Samer mentioned. There's Cambridge, there's quite a few other ones that are more peer related, which would be, which might be more appropriate, but we're still sticking to using this public equity benchmark because we like the opportunity cost lens that it provides us. So I'm not too sure if we answered your question or not, Trustee Pakunis.
You did, and my question was geared around, is there a better proxy for our performance or a better benchmark against which to measure, and the Cambridge Associates benchmark being, I think, a better indicator. I understand your point about that you're looking at the opportunity cost. It feels to me though like we're going to time and time again have to talk about this public to private markets disconnect. I think that when you're assessing, our allocation to private equity, that's the time to look at the history and the analytics around public versus private. But it just feels to me, we have the same issue on the credit side. I understand credit's a little bit harder to isolate a pure benchmark, but for me, it feels like, at every turn we're comparing to a benchmark that we're gonna lag when the market's strong, when the public markets are strong, and we're gonna be better than when the public market's weak. I just urge us to consider, might it make more sense to focus on the public market benchmark when we're making the portfolio allocation decision, the how much between asset classes, and the private market or Cambridge Associates benchmark as we kind of look at this on a periodic basis. Again, I think I can go do that myself, so it's not a big deal. But that's what I tend to do, is look at how are we performing relative to same benchmark, and it feels like we're outperforming relative to that same benchmark. That was the only point I wanted to make.
Thank you.
Thank you. We'll definitely look into that and we'll have a discussion afterwards.
Yeah, and again, what I'll do is I'll just look at the Cambridge Associates benchmark coming into these meetings and see how we're doing relative to that. I don't,
Sure.
because
I
that's
think
what I really.
we can easily put a secondary benchmark on.
Yeah. Yeah.
So that's something that NEPC can do for us.
Yeah.
But as far as the true benchmark, that's something that ultimately is approved by the board.
Yeah.
So it's something we'd have to kind of bring to the IC and the board at some future time.
Sure.
But having a secondary benchmark to compare and contrast is easy to do.
Yeah, I would be concerned if we were lagging that secondary benchmark, which is a better proxy for our underlying investments. That would make me concerned. You know, here I understand the public versus private, you know, disconnect. So appreciate that. Thanks, everybody.
Of course.
I like your point, trustee Petkunas, and I appreciate you adding that. And Ms. Dean, did you have a comment?
I had just a quick, I just wanted to second Jay's comments and I like the recommendation that we would have a secondary benchmark. Jay's right, we've gone through this now many times. And so I think that would be most helpful.
If I may make a comment, this is Rose Dean from NEPC. The Cambridge benchmark or any peer group benchmark is appropriate to look at whether the portfolio that you have is being implemented in such a way that it exceeds other selections that the staff could have made. So I think it's relevant to look at that and determine whether this portfolio selection has been effective. The comparison to the public equities benchmark is for the board to understand whether the allocation decision over a long-term period has been effective in achieving the return target for this portfolio. Instead of putting that allocation dollar into public equity over the long term, if the private equity allocation has exceeded that public equity benchmark, then the allocation was appropriate and additive to the portfolio performance. So looking at both will be informative in both ways.
That's very helpful perspective. And I agree with you. That was my point, was as we think about the portfolio allocation, the allocation across asset classes, I think that the public markets benchmark is relevant. And as we think about, we made that decision, now we've instructed the team to go execute, then having a like comparison for a benchmark, I think is going to be helpful. So I don't think we need to do anything more than just add the secondary benchmark. I'm not suggesting we swap one for the other, but just being able to see them both, I think will just help with the narrative, and it'll prevent me from asking the same question and trying to remember every time we come back to this. So I appreciate it. Thank you all.
Of course. Actually, I've been thinking about it while everyone was talking. I think probably we'll add the MSCI Burgess Index, which is wider and it's not biased like Cambridge, because Cambridge is technically what they invest in. So Burgess MSCI is all buyout. So I think it would be more reasonable to add it. And you're absolutely right. It will compare apples to apples.
Thank you.
Of course. I will move now to page 69, if the team doesn't mind. So I will speak on what's happening in terms of the landscape of buyouts, and I will focus I usually focus on the US, and this time I will repeat the same. The US is the driver of private equity globally, and everything else just like follows what's happening in the United States. In terms of activity, we've witnessed year to date. When I say year on year, this is as of June, because there's collecting data as usually happens quarterly. So this data for this quarter will be available in our next meeting. So we've seen activity up 12%. It's the first time, I would say, the most robust quarter that we've seen since 2022. So what we spoke about last meeting, that we see a recovery and things are getting better. Now the numbers show it. And there's numbers that we see that are not yet public. I would say even this summer, usually activity is lower in the summer. This summer activity have been really decent, and it will show us next quarter as well. So in terms of year to date, and that's like January to June, we had $32 billion in terms of activity, and that's around 4,000 deals. I will go through the graphs this time. I will take more time going through the graphs because it's good to show the landscape, what's happening. In terms of sectors, we've seen a recovery in technology, and technology in particular, I would say software. Software is, even our portfolio is more software than technology, tech meaning the venture capital style. So activity have been recovering this quarter. On healthcare, we see the percentage of healthcare deals dropped. And within that, healthcare, I would say pharmaceuticals and M&A activity in pharmaceuticals have been the biggest portion of it. In terms of capital raising, as everyone, I think, Trustee Bakunis would know much better what's happening on the fundraising. Every other manager is extending the time to capital raise, and given that there isn't much going on, but I would say the large funds and actually the mega funds are the bulk of capital raising that happened the first half of this year, and you can see here it's around 86%. If we can move to page 70. And these are in real numbers. As I mentioned earlier, so 2021 and 2022 are the extreme, and I would love to smooth them out within what happened in 2020. It will make the graph less extreme. But I would say I always, my benchmark is how do we look in terms of activity compared to 2018 and 19? And we are getting there. I think in the coming 2 quarters, we should look at least like 2019, and that's a good thing. Interest rates, the first fund, Federal Reserve cut of 50 basis points will open the path for more activity and better capital markets activity on M&A and debt markets. In terms of exits, you can see here that 2024 will definitely look better than 2023, and that's on the right-hand side of the page. If we move now to page 71.
Samer, one quick question.
Yes.
This is Jay. That 24 data that's not annualized. That's half
Yes.
the year, right?
Yes, half the year. Exactly.
Okay.
Yeah.
That makes sense.
Absolutely. If we move, now we are at 71, please, if you don't mind. Yes, in terms of technology, and technology has been the biggest driver, I would say, in private equity in terms of size. And if you compare it to an S&P, technology in private equity is much higher than the percentage of the sector of S&P. So if S&P, we think it's high, just imagine the private markets. So technology is still, it's getting better, but it's still activity lower. And you can see healthcare is much more silent, I would say, which is the right-hand side. If we move to slide number 72. Sorry. The right-hand side shows exactly what's going on. As I explained, the funds that are 5 billion plus have the biggest chunk, which is, I'd say, the largest since 2017. Mid-market is where I would say, what we like. It's been stable. And of course, the under 1 billion is getting smaller by the day. And this is what always happens when we have this type of slower capital raising activity. I will stop here, take any questions, and otherwise I will be back.
No questions?
Nope.
Thank you, Samer.
Thank you.
We're going to move to real estate, and hopefully Taylor is on. Turn your camera on, Taylor, if you're there.
Yes, my camera should be on, and hopefully you can hear me.
You can. Thank you, Taylor.
Okay, wonderful. Good morning. I'm Taylor Mammon, CEO of RCL Co-Fund Advisors. As Mr. Fateri mentioned, I'm our RCL Co-Fund Advisors, or RFA, is the real estate consultant working with ASRS. And I'm pleased to be with you this morning. If we could jump to page 76, this is where the presentation begins. This outlines the real estate performance through the fiscal year ending June 30th, 2024. As you can see, real estate continues to outperform its benchmark across all time periods, with the exception of the quarter ending June 30th. which we view quarterly performance as less relevant given how real estate, both within the benchmark as well as within the real estate portfolio at ASRS, is valued. So overall, we see ongoing outperformance. These returns, as you can see, and as NEPC mentioned as well, do reflect the meaningful decline in value that has occurred across the real estate asset class since the Fed began raising rates in the first half of 2022. We're starting to see some glimmers of hope that this devaluation trend is starting to reverse. Transaction values are up over the past quarter in multifamily, industrial, and retail in particular. And we're even starting to see increasing values in the open-end fund universe. And those are all appraisal-based returns as well. So we, of course, do not have a crystal ball, but there is reason to argue that June 30th may be close to a nadir in terms of values and therefore returns. Let's jump to the next slide, page 77.
Taylor, this is Jay.
Yes,
One
please.
quick question. Could you go back to that other slide? Of
course.
So the bottom left chart, which shows the strategy sorted by IRR, that the real estate operating company, is that Mill Creek?
That would be three companies.
Three companies? Yep.
Yeah.
And that is, how are those marked? So it just, because if you isolate that outperformance, then that kind of bolsters or buoys the performance of the rest of the business. How are those marks calculated? Is that just a consistent multiple on cash flow or DCF or what, how?
Sure. So those are appraisal-based valuations completed once a year and then adjusted quarterly for cash flows essentially occurring within the quarter.
But so that would suggest, but is this, and this is a year-to-date number?
This would be a June 30 number.
So the implication being that the multiples or the discount rates haven't changed, but the actual performance from last year relative to this year for those opcos has increased, and thus you're cycling that through your valuation model, and that's how you get to the 70.
I think those values are since inception returns for each of the strategies.
Okay, got it. Since inception. Got it.
Yeah.
Okay, that's helpful. Thanks.
Yeah, sure. That should have been clarified on the chart. Sorry about that.
No, thank you.
All right, if there are no other questions, we can move on. So the next chart shows the composition of the real estate portfolio by vehicle and vintage period. As you can see in the pie chart, most of the portfolio is in separate accounts. We have, and ASRS has, a great deal of transparency and control over the assets within those separate accounts. We perceive a tremendous amount of embedded value creation in the separate account portfolio. There are a significant number of assets under development in the multifamily, build to rent, single family, and data center sides. So all of those are largely being held at cost, and think that there is great potential to outperform within the separate account portfolio going forward. Over the past couple of years, one of the biggest contributors to outperformance has been real estate debt, which is the next highest share of the portfolio. And ASRS's partners in that space have been able to take advantage of illiquidity in the market to generate strong returns. The chart on the lower right-hand side of the slide demonstrates cash flows and really a long period of chasing and increasing target allocation, as certainly members of the staff and many members of the board will recognize as well. Since 2023, we've been working to reverse that to hit the new target of 17%. I think everyone can appreciate the market since 2023 has been a challenging one in which to sell, but ASRS is taking advantage of opportunities to do so where it can. Improved liquidity in the last few months is helping meaningfully, and we think there are some meaningful recapitalizations and sales in the works that should distribute meaningful amounts of capital to ASRS. So expect to see greater distributions in 2025. Again, if our crystal ball isn't too hazy at this point in time, I think we'll see increased liquidity and a accelerated path to 17%.
Taylor, before you move off of this slide, a couple of quick questions.
Please.
On the separate accounts, I know one of the things we've talked about historically is that what kind of a differentiator for ASRS is that we have a high degree of control over the sponsors, or discretion, if you will, in those separate accounts. In terms of the mechanics of the decision making, I know RCLCO is an advisor to us, and are you guys making those decisions? Are we collectively making those decisions with the in-house real estate team, or is it how does that decision making happen vis-a-vis the sponsor judgment?
Yeah, absolutely. And I'll welcome any comments from the ASRS team as well on this, since they are involved. It's a very collaborative process, I'd say, initially between the sponsors themselves and RFA. ASRS does engage us to conduct hold sell analyses on every asset at least once a year within the portfolio. And so we are taking an independent view based upon existing valuations and go forward underwriting relative to where the asset is in its life cycle, whether it's at peak value or not, whether there are opportunities and threats facing each asset going forward. From there, we'll begin a active conversation with Mike Copeland at the ASRS team. He receives every week a list of all hold sell analyses that have been completed during if any, during the course of the week. And we engage in discussion about the appropriate decisions relative to that asset. If an asset is selected to be disposed of, we then engage with the separate account manager. If that hasn't already begun, they'll then proceed to source a broker opinion of value if that hasn't already been done. And from there, again, in collaboration with the sponsor and ASRS, we'll prepare a disposition recommendation that recommends a minimum price, which is essentially the point of indifference at which ASRS should either hold on to the asset or sell it. And then that above a certain threshold is voted on by the Combined Asset Class Committee of ASRS. And then the manager is then mandated to take the asset for sale.
And then when the manager sells the asset, generally are these separate accounts structured so that then we're reinvesting with that manager and again approving that, or does the separate account extinguish and it's start over again somewhere else?
That is always at ASRS's discretion. So within the operating agreement, ASRS has the right to recycle capital or reinvest capital into new opportunities.
Yeah.
It also has the right to turn it off, and in some cases is doing so.
Got it. And then that dovetails into my second question, which is just, we know 50 basis points of interest rate reduction and expecting potentially 25 to 50 basis points more. I spent 10 years when interest rates were low trying to prove that real estate cap rates and interest rates weren't highly correlated, and I was wrong. I think the reality is that for the first 50 basis points of interest rate movement, cap rates and interest rates aren't highly correlated, but when you start approaching, the 100 basis points of movement, that's when the correlation really kicks in. Is that kind of RCLCO's view too, that with another round of interest rate cuts, we'll likely see some cap rate cuts and then potentially accelerate the dispositions to try to bring that allocation down closer to the 17%? Is that kind of?
Yeah, in general, yes, absolutely. I mean, where we're seeing cap rate compression today, fairly remarkably, is in multifamily. And I think that's really driven primarily by market expectations of enhanced rent growth. And so, the current yield plus rent growth equals the stabilized yield that many investors are anticipating for multifamily. And so, of course, there are those additional factors that go into acceptable going in cap rates within the market. But in general, Jay, I think that's exactly right.
And you're also seeing in the multifamily business, because of the supply that's been raining down over the last couple of years, net effective rents dropping. So just an empirical purchase price relative to those reduced temporary net effective rents is driving cap rates down too, right? The buyers are buying a lower cap rate because to your point, of growth expectation and just a current dip in rents, right? So,
Yeah.
okay, all that
Yeah.
makes sense, Taylor. Thank you.
Yeah, sure. Dip in rents in the Sunbelt markets, but continued growing rents in the gateway markets.
Sure.
And ASRS
Yep.
is investing in both, which has been fascinating to watch the difference in performance across markets. So
For
yeah.
sure. Sounds good. Appreciate
Thank
it.
you,
Taylor.
Trustee
Thank you.
Pecunis. Good questions. Thank you. Let's jump to the 2 pages from here. So page 79, which outlines the ASRS real estate house views. I always find it helpful when presenting a house view like this to break it down into the property markets, which represent supply and demand for real estate, so square footage, units, and so on. And then real estate capital markets, which represent demand and supply for real estate investments from both equity and debt investors. On the property market side, with the exception of office, real estate fundamentals have remained fairly healthy. As Trustee Pecunis was mentioning right now, and on the multifamily side, we are seeing moderate near-term oversupply of newly delivered rental units in Sunbelt markets. Gateway markets have remained fairly tight following their challenges during the COVID pandemic crisis. But both of these, in both types of markets, we are seeing long-term housing undersupply throughout the United States. And so there is anticipation of continued rent growth throughout, I'd say, rental housing. In terms of industrial, we have seen moderation of the extreme demand that the industrial market experienced in the wake of COVID and government stimulus. But vacancy is still low relative to historic levels. Rents are still growing in most markets. And so industrial has and is expected to continue to perform. The other property type listed here is office, which continues to be challenged overall. But we are seeing continued evidence of strong demand on the office side for the highest quality locations and buildings. And so we're seeing increased market segmentation, essentially in the property type that we think might lead to some interesting investment opportunity in office. The property type overall is likely going to go through a period, maybe a prolonged period of right sizing the supply before we start to see overall healthy fundamentals for the property type overall. On the capital market side, as mentioned, we're starting to see stabilization of and maybe even recent evidence of contracting cap rates in multifamily and industrial. Transaction volumes in multifamily increased year over year for the first time in a few years. With greater clarity regarding the Fed's rate path, we expect to see improved transaction volume as there's just greater certainty into value. Debt is still tight, but has become much more available relative to, let's say, a year ago today. CMBS issuances are up meaningfully. More bids from lenders when borrowers are sourcing debt and so on, all of which is also helping to improve transaction activity. So maybe just the bottom line when it comes to ASRS's investment activity, new investment activity has been low in 2024, given both ASRS's overallocation to real estate and limited volume overall. But in very selective instances, existing partners are taking advantage of opportunities that emerge in the challenged market. Anything that has worked has reflected an overall upgrade in quality of asset and location and demonstrated high yields with conservative underwriting. And then we're also focused on dispositions in order to hit the new SAA target, but these have likewise been limited relative to the ideal as we've sought to avoid fire sale pricing in really all instances. When they've occurred, it's because we collectively believe values are at their peak for at least the medium term, and or they are in non-strategic partnerships, of which ASRS has a few. And as I mentioned, we expect increasing disposition activity really in coming months and certainly in 2025. So with that, I'll close my prepared remarks and open it up to any additional questions.
That was
Trustees?
helpful. That was helpful. I didn't have any more questions. Thank you, Taylor.
Thank you. Appreciate
I
it.
don't either.
Thank you very much.
Thank you.
Moved.
Appreciate your time.
We'll move to Mr. Trusiak now. Presenting on credit and then IRS.
Thank you, Mike. My name is John Trusiak, Fixed Income Portfolio Manager, and as Mike mentioned, I work daily with Al on the credit portfolio. So we can turn to page 83, please. Thank you. And so first I want to touch on the overall 1, 3, and 5-year returns for our internal credit portfolio. As you can see, the one-year performance at 9.14%. This is within our target of 9 to 10%. And then looking at the 3 and 5-year period, also within our target. So very proud to be hitting these returns greater than 9%. And then over the 3-month return is 2.5%, which is also a very healthy number. And we expect that to be similar the next time we're all sitting at this table as well. Now I want to touch on the benchmark return, which I know we've touched on these public benchmarks as it relates to private equity, but how it relates to credit, the LSTA has had a really strong year. That's what the credit benchmark is benchmarked against. And so as you can see, we're underperforming the benchmark for the 3-month and 1-year returns. However, if you look past that and look at the 3, 5, 10, et cetera, we do have outperformance versus benchmark. So one thing I want to point out is what happened with the LSTA and why did it rally? So the public debt markets for the leveraged loans and broadly syndicated loan market in 2023 was really non-existent and not a lot of activity. In 2024, it's a total different script. The public debt markets have strengthened. New issuance is up. With the new issuance up, spreads have come in. This has resulted in repricing of loans within the public benchmark. And over just this year, over 30% of loans have been repriced in 2024. And what this does is drive spread compression in and increase prices on the leveraged loans within the public benchmark. Just for the quarter ending 3/31, the LSTA benchmark was at a 2-year high, and same story for this quarter ending 6/30 as well. So I just wanted to give some color on what's happening within this benchmark and why the credit portfolio is lagging that benchmark in the short term. But over the long term and intermediate term, we continue to expect performance in the 9 to 10 range, and overall expect to exceed outperformance when looking at the public benchmark.
John, if I may, a couple of comments on the Morningstar LSTA Leveraged Loan Index. So the loans that populate this particular index, they're not the due diligence and the underwriting that happens in this particular space. It is not as robust as what we have in our separate accounts. So there will be periods of outperformance, there will be periods of underperformance. But when it comes to let's say bankruptcies that happen in this space or write-offs, our expectation is we're going to see it exacerbated in the leveraged loan index, really because of the credit quality. So when things get messy, it'll get messy in the leveraged loan index and not necessarily our portfolio. So there's a little hidden component to that. We're using this publicly traded benchmark plus 250, and that plus 250 is compounded in the benchmark, and still looking over the 3-year, 5-year, 10-year, outperforming even that plus 250 over time. So we're pretty comfortable. We're comfortable with this benchmark. I don't think there's any other benchmark that we could use as a secondary benchmark. This is pretty good. It's just the nature of the dynamics that happen between private and publicly traded, the broadly syndicated loan benchmark. Any other comments, John?
Yeah, thank you, Mike. And Mike was spot on. So the loans that make up the public benchmark are covenant light loans versus in our credit portfolio, tight covenants, heavily negotiated in our favor, in the creditor's favor. And overall, the recovery rates are higher. We expect to be higher for any defaults in our portfolio, as well as just an overall lower default rate versus the LSTA benchmark. And hearing no questions, so I'll move on to page.
Quick question though, just a couple of clarifications. This is very helpful. Thank you. And I won't rehash the public versus private, just a couple of questions though. One, the plus 250 basis points, the index plus 250, that's just an illiquidity premium or it's just to reflect illiquidity of our portfolio versus the public. Is that right?
Exactly right.
And how do we get to 250 versus 200 versus 300? How do we land at 250?
Let's throw Paul under the bus on that one. 'Cause that was just-
I guess my point is, if it was 200, we might have a different answer than if it was 300. And I'm guessing there was some science behind it, but that'd be interesting to touch upon down the road. But the other question I had is just, you mentioned that spreads have compressed in the public loans, and that's translated to increased pricing. Did I understand that right? And that's what's kind of driven the outperformance. And can you maybe just explain that a little bit more for a novice?
Sure. So in the public debt markets, new issuance has been up. So when more leveraged loans are being issued, spreads are coming in. That's just the correlation there. And so basically when these spreads are coming in and you're repricing loans, the price of the loans are also going up. So not only is the benchmark having their yield return, you're also getting price appreciation within the benchmark as well.
Got it. Okay, so it's the combination of price and income return on the benchmark that's a function of the repricing and based on collapsing spreads.
Apologies on the 250 plus. So all kidding set aside, that really was a decision between staff at the time. So LIMO, but more importantly, NEPC. I was looking back to see if Rose was here, but she had to step out for a quick phone call. So ultimately that was decided at that point in time. I don't know if Paul has any other color to add, but it was really an NEPC decision as well.
Any more questions? Thank you.
Thanks.
Great, thank you. Moving on to page 84, please. So on this page, Al and I would like to point out, so you can see total credit asset class for the fiscal year 2024 was at 12.2 billion. And now this is 22% of the total fund. We were aiming for 23% per the strategic asset allocation, and that was the goal. So why did we fall a little below 23%? A couple of reasons. One, total fund grew more than expected due to the public equities rally. And then a couple other reasons also include the pacing plan for our current commitments that are in the ground are happening a little slower than we anticipated. Meaning, for example, in our private debt partnerships, where we may be expected to have been called more capital than has currently been called. So what are the reasons for that? One is the M&A market has been largely non-existent versus prior years for M&A activity. And private credit is a big financier of M&A transactions. So that's one of the reasons we are at 22% right now. A couple of things I want to point out, though, just talking with our partners in our partnerships, we are expecting a much more robust M&A market in this upcoming 12 months, as well as some M&A activity to end the year. So we do expect the overall pacing of capital calls for our commitments in the ground to be heavier than it was for the first 6 months to have started the year. And then so with a little less M&A activity than originally planned, our partnerships are still finding creative and flexible capital solutions to provide to borrowers within this asset class. And the overall net returns that we're seeing on new deployment heavily exceed our kind of expected 9 to 10% net returns for this asset class. And then moving on to page 85, please. And I just wanted to show a quick graph for the overall credit asset class sub-strategy exposure. As you can see, the US corporate private debt and European private debt makes up a majority of the asset class. But we also include real estate debt as well, non-performing loans, middle market CLOs. Those make up everything above 5%. And so I just wanted to give a look to the committee, how the portfolio is currently positioned, as I'll touch on some possible reallocation on page 87, our house views. But I'll stop right here if we have any questions. Hearing none, so we'll proceed to our credit house views and overall conclusion. So as mentioned, as of June 30th, 2024, it was at 12.2 billion invested for the credit asset class. Like I said, 22% of total fund versus an SAA target of 23%. We look forward to hopefully inching up more towards that 23% as part of the total goal, as the M&A market picks up and capital calls move a little more closer to our anticipated pacing plans. But overall, the new loans and the new transactions that are being done within this asset class via our partnerships and commingled funds that we're invested in exceed the 7% target return for the total fund and fall in that 9 to 10% target net return bucket for private credit, if not exceed that overall expectation for how we're looking to invest with regards to return. A couple of things I want to point out. So we're working with our existing partners right now. So these are partnerships where we have been partners with credit managers for multiple years, some decades. We're looking to upsize some possible commitments where we see fit and where we see strong risk-adjusted returns. So we're very comfortable doing this. These are partners that we already have partnerships set up with. We have a look through at the returns that they've given us. And so we're very comfortable looking to retool the allocation within credit. So on that graph you saw on the previous page where there is a large majority in corporate debt in both the US and Europe, looking to maybe decrease that a little bit and allocate it to other strategies within credit, other credit, asset-backed finance, stuff that we have a look through and believe there are strong risk-adjusted returns to be had. And so that's us just trying to actively manage the portfolio as best we can with our commitments and partners that we already have. And so with that, we continue to operate that strategy, like I just mentioned, within our implementation plan and with full internal staff approval and communication as well. And with that, those are my final remarks and open up to any questions. Thank you.
Questions? Nope. All right.
Thank you.
Thank you.
John's gonna put on his IRS hat now.
Sure. So we'll turn to page 91 now, please. And we will change asset classes to interest rate sensitive. And so as everyone here knows, interest rate sensitive, it's our lowest allocation of the asset classes. As of June 30th, we were at a 3.9% current allocation, so far below all of the other asset classes we've talked about. However, still very important as it serves as a source of liquidity to the fund and provides some correlation offset when risky assets might sell off, at least historically. But anyhow, if you can just see the outperformance we're very proud of over the fiscal year, 1 year, 3 year, et cetera. Outperformance versus our benchmark, which is the Bloomberg US Treasury Index. But overall, you'll see over the 1, 3, 5 year periods that this is an asset class that has basically not given us a return that gets anywhere close to our standards of 7% total fund return that we're looking for. And so that's why it continues to remain an underweight in the portfolio. And that's why we continue to recommend it being the smallest asset class within the total fund. However, I do want to point out that it is largely internally managed by myself as well as the Deputy CIO, Al Alimo. And so we continue to manage it daily. For the current allocation on the right-hand graph, you'll see 3.9% that represented about $2.1 billion of capital invested in this asset class. I just want to point out that, like I said, this is a source of liquidity for the total fund. So the next time we're all sitting here, you'll see this number closer to 3%, which is still within our range of asset allocation. Next page, please. On this slide, it's just a summary of where we sit for the internally managed account, which, like I mentioned, is 82% managed internally by us. I'd like to turn your attention to the bottom left table. So you can see the yield to worst of the benchmark was over 4.5%. I checked the benchmark yield to worst this morning, and it's down to 3.72%. So, and this is just basically a replica of the yield that the bench mark throws off, and as well as our portfolio, because we're closely aligned to the benchmark. And even that yield, you know, like I mentioned, 7% total fund return we're aiming for, it doesn't get us anywhere close to that. And with price volatility within the benchmark, as well as our portfolio, it's driven those returns that you saw on the previous page to, over the 1, 3, and 5-year period, be sub 2%, closer to a 0% return for this overall asset class. We can move on to page 94, please. And if I'm not hearing any questions on this asset class, I'll wrap it up for our overall house views. So like I mentioned, we'll continue to be underweight this asset class. Interest rate sensitive, like I said, was 3.9% as of 6/30. When we're all sitting down next time, it will be closer to 3%. But we still view it tactically as a source of liquidity mainly, as well as, like I said, doesn't historically correlate when risky assets sell off. So it is being used for its purpose. Like I said, there was a redemption request in this asset class that were moved to master cash for other uses. So it is still continuing to be used by our internal staff for its main function, which is a source of liquidity for the other asset classes and master cash for the total fund. And with that, I'll wrap everything up. Thank you.
Seeing no questions, thank you very much.
And I'll circle the wagons with the last presentation. So we're on page 97 of 137. This is October 31st, 2024, preliminary performance. In the upper left-hand corner, you see the market value is 56.4 billion. So I believe that is a new high. Just to remind you, just 2 months prior, we're about $1 billion lower than that, 55.4 billion. So a good bump up of $1 billion, even with the negative cash flows that happened over the previous couple of months. It was really driven mainly by public equity, the strong public equity market. At the top, again, total planned returns, 1 year, 3 year, 5 year, 10-year. All numbers exceeded the actuarial assumption rate of 7%, with the exception of the 3 year, just like we had in this presentation deck. And the same thing with excess performance. You'll see excess performance, the 3, the 5, the 10 years of 73 bips, 31 basis points, and 112 basis points. Again, the one exception being the 1 year. The reason we're in negative performance is really, we just talked about it, private equity underperform, credit underperform, and those are meaningful parts of the portfolio. But other than that, that wraps up my formal comments, and that ends this particular agenda item.
Thank you very much, all of you, for that. All right. We have Robert Butler.
All right.
Thank you.
If we were at a conference, I'd say I'll try not to go too long so everyone can get to lunch. Robert Butler, the Investment Risk and Compliance Officer. We'll go ahead and start on page 101. And just a reminder that, like most of the rest of the material that's been presented today, this analysis is based on our holdings at the end of June. And like past presentations, we'll start off with some overview of our risk philosophy, followed by the updated analysis, including information on our largest public and private managers. And jumping to page 102. And here I always like to just highlight that 2 of our main goals are to maximize rates of return for acceptable levels of fund risk and to mitigate the volatility of our contribution rates. And then we'll go ahead and skip to page 106. And here we have the correlation matrix of our major asset classes. And some of this has been touched on before, especially by John talking about the role of interest rate sensitive. While it is a lower allocation for the fund and the returns have not been spectacular, as you'll see in the kind of darker green, this shows that there is a lower correlation between interest rate sensitive and the rest of our assets, which is very beneficial in building a portfolio of multiple assets. And then on page 107, on the left side, we have the dollars allocated to the various asset classes we invest in. On the right, you'll see the contribution to volatility from those asset classes. And you can, as noted, public and private equity is close to 55% of our dollar invested, but around 74% of the contribution to volatility. And as previously noted in this, when discussing these slides, this is a much lower contribution to volatility than you would see in like a classic 60-40 portfolio, where there's 60% in equities, 40% in bonds, but about 99% of the volatility comes from that equity portfolio. And on page 108, this idea is sort of highlighted again, where you see the total contribution to volatility from our various asset classes. And you can see the bottom two, blue and orange, sort of decreasing, being pushed out of the way as we've added additional asset classes, which has lowered the contribution to volatility from our equities. Then moving along to page 110, try to give kind of the standard disclaimer that this is a look at our portfolio as of 6/30. If we had that portfolio hypothetically in these past crisis scenarios, how would that portfolio have performed? And you'll see the gray bars are the excess returns of our 6/30 portfolio compared to how our benchmark portfolio would have performed in those past scenarios. And so this shows the alpha or outperformance added by both decisions from an asset allocation standpoint as well as implementation standpoint. And then I'll go ahead and skip over to page 113. And this shows our top 20 global issuers. And this is almost a replication of what Cole shared from the equity portfolio, other than the US Treasury or the USA exposure, which is primarily the treasuries. But the rest of these names are mostly from our large equity holdings. And I believe the 15% concentration of our top 20 issuers is the largest I've seen since I've joined. I don't have too much more to add on that, other than I think it's the first time it's hit 15%. Then I'll move on to page 114 on our public investment managers. As has been mentioned several times, we are our largest manager. These numbers don't include any futures or cash that's been equitized with futures. It's just our pure equity and fixed income exposure. And you'll see obviously BlackRock and Legal & General are very important partners of our fund. And on page 115, it's the summary of our largest private investment managers broken down by asset class. And here I just like to point out that you can see the much higher concentration with our managers in private credit and real estate. And that's also where, as has been mentioned, we take advantage a lot of like separate account structures and fund-of-one structures to really leverage our size and get kind of better terms with those partners. And on 116, it's similar slide. It's our largest investment managers on the private side, but for all the asset classes combined. But again, you can see kind of the higher concentration with our real estate and private credit managers. last but not least, on 117, it's our largest external managers. And then again, I'll just point out that we are our own largest manager with running the US equities and most of fixed income internally. And I'll stop there to see if there's any questions before jumping over to compliance.
I don't see any. Thank you.
All right. Let's move to page 121, please. So we'll be going over our internally managed portfolios, pre-trade compliance, our bank's compliance program, and our private markets investment compliance program. I have to apologize to RCLCO. The bullet point is inaccurate. The 2022 review has been completed. I apologize. It's fixed in a later slide. So quickly on page 122, I just highlight that we use Bloomberg for our trade order management system, and we do have built-in pre-trade compliance rules. And they help keep the portfolio in line with our guidelines. And on page 123, there were no exceptions during this review period. And then also there were no exceptions for September, but I had to have my slides turned in too soon to say that. And the last report covered the period from February 2024 through May of 2024. And I'll actually go ahead and skip ahead to 127. And this is dealing with our bank's monthly reporting on the compliance side. There were no exceptions reported, or no major exceptions reported from August, as well as the time period noted in the slide of May through July. And the previous report also covered February through April of 2024. And then on 128, it's the summary of the review that RCLCO does for our real estate separate account program. Again, they basically just review that all the policies are being followed, and they double check the calculations performed by the managers to make sure they are consistent. And on page 129, RCLCO has completed all 23 compliance reviews for the 2022 review period, and the 2023 review period will start this fall. There were no major inconsistencies found, and when there are even small ones, RCLCO has been working with those managers, but pretty happy with the compliance overview program there. And then on 130, I'll just highlight that we work with Makita, another investment consulting firm. They do a similar review as RCLCO, but for our private equity and private credit, and then a potentially real estate funds. One difference, their reports can be a little bit lengthier, and that because we have so many of these investments, they do a sampling process and look at 30 to 40 each review period out of, say, 200. And if that fund hasn't been reviewed before, they will look back through inception. So it could be a review of, I don't know, 5 to 7 years worth of material, where the RCLCO reviews are just on that separate account program. And so they're doing an annual review every year of the previous year. And hopefully that makes sense. And so on page 131, Makita has completed 38 reviews for 2020. There's one more to go for 2020, and for 2021 review period, they've actually now completed 29 with 3 to go. So the 2020 and 2021 reviews should be finished soon, and then they will begin on the next set of reviews. And hopefully that's all clear with all the different numbers. But that's the end of my presentation, unless there are any questions.
I don't see any questions, so thank you very much. All right. Mr. Mattson,
And I have no additional comments. Thank you.
all right. Any call to the public requests?
We do not have anyone wishing to speak.
Any, excuse me, any requests for future agenda items? No? Okay. All right, well, our next investment committee meeting is December 18th at 9:30. And I guess with that, we will adjourn the meeting. Thank you.
Thank you. Thank you, everyone.
Everybody.
Thank you everyone
Thanks.
for attending. The time is 11:01 a.m.
Thank you. Thanks, Taylor.